Hello everyone, welcome to Prime Investor. Today we are going to discuss Parag Parikh Flexi Cap, a fund that has been an investor favorite for the past couple of years, but which has now started to cause a little bit of worry about its performance. Now, why was it such a favorite? Primarily, this was because it could invest up to a third of its portfolio in international stocks, more so US stocks, more so tech stocks such as Alphabet, Amazon, Meta, and so on. At the same time, it was delivering chart-topping returns. Now, this situation changed from January this year, where the mutual fund industry as a whole hit the ceiling set by the RBI on international investments. And that meant that Parag Parikh Flexi Cap could not make fresh investments in international stocks. And at the same time, returns started to dip. Its one-year returns are actually about 2 percentage points less than the Nifty 500. So should you be worried about performance? Should you continue investing or stop investing? In our view, there is no need to be concerned about the fund's performance. You can absolutely continue to hold the fund, continue to make your investments in the fund. It remains a good long-term bet. We recently did a detailed analysis on this fund on our platform. So let's just refer to that to understand the fund's performance and why it remains a good long-term bet. The first thing to remember about Parag Parikh's performance is that returns hasn't come only from its international exposure. Yes, its US stocks, because of their outsized returns, did help the fund's performance. But its domestic portfolio, those choices were also helping contribute to fund returns. For example, it had picked stocks such as Bajaj Holdings and Investments, CDSL, India Energy Exchange, Persistent Systems, Emphasis, all of these, ICICI Bank, all of these have been good performers and have contributed to the fund's performance. So it's not the performance of the potential is not dependent only on its international exposure, and those restrictions there are not a deal breaker for the fund. The second thing to note about its portfolio is that it has a concentrated portfolio. It follows a focus strategy where the top weights are very high. If you take the top 10 stocks, it's actually 60% of its portfolio typically. When you have such high weights, any underperformance in those stocks is going to obviously hit returns. So take its international exposure, for example. The top weights, if you see, like Alphabet or Microsoft or Amazon, they have actually not done well at all, and the weight is high. So similarly, even in its domestic portfolio, stocks such as HDFC, Power Grid, recent addition was Coal India, all these stocks have been flat to declining performers, and this has impacted near-term returns. When a fund follows a concentrated strategy, when it has a focused strategy, short-term underperformance is par for the course, because any underperformance in these top weights is going to have a disproportionate impact on the fund's returns. But the reverse also happens. When these stocks rally, the returns are really going to pick up. So this kind of short-term blips is something that needs to be accepted about funds that follow such kind of a focused approach. The next point to remember about the fund is the way in which it picks stocks. So Parag Parikh doesn't churn its portfolio much. It follows a very long-term buy and hold approach. It looks for very sound businesses available at attractive valuations, and it's willing to hold these stocks for a long time until it gets picked up by the markets. ITC, for example, was long a part of the portfolio, and the fund has booked profits in the recent rally that has happened in the stock. So this kind of strategy, long-term buy and hold strategy, also means that in the short term, in periods like 1 year, 3 months, 6 months, the fund is very likely to underperform, and it has done that before. In periods like 2014 or 2017, the fund has trailed the Nifty 500 index. it has over the long term though, bounced back. So if you see, the longer term returns are still well above the index. The final thing that you need to look at when you're looking at performance is the extent of underperformance. Okay. Now, if we take the very short-term returns for Parag Parikh, if you take like the 1-month returns or 3-month returns, if you see, the average underperformance is not very deep. It's only at about 1 to 3 percentage points on an average when compared to the Nifty 500 or even the average for the category. Now, such marginal underperformance is not very worrying, because it will not be very difficult for the fund to bridge this gap provided its strategy and portfolio are sound, which is the case with Parag Parikh. And you can also get some comfort from the fact that this underperformance already shows signs of improving. It's already narrowing. If you take the 1-year returns of the Nifty 500 and the fund, if you see, the gap between the index and the fund was much wider before, and that gap is narrowing now, which means that performance is picking up. So this is an added level of comfort that while it is underperforming, the gap is not very steep, and this gap is already showing signs of narrowing. So it continues to retain faith in the fund's ability to pick up over the long term. So if we put this whole analysis together, essentially what we are trying to say is Parag Parikh Flexi Cap's performance is not hinging only on its overseas exposure. Overseas exposure is only a small part of its portfolio. It's a good diversifier. It's a good reason why this fund is different from the rest of the funds in its category, but it is not an international fund. Second, its domestic portfolio choices have also been good. They have also delivered well for the fund, and therefore the continued restrictions on international investing is not detracting from the fund's potential. The third is other factors that make this fund very different from the rest of its category is its very low volatility and its brilliant ability to contain downsides during correcting markets, where it is far and away better than any of the other funds. So including it in a portfolio will have differentiated performance. And finally, its buy and hold long-term strategy means that it is going to underperform in the short term, and you need to be willing to see this level of underperformance continue to hold and benefit when the fund picks back up over the long term. So we continue to maintain confidence in the fund. It remains a part of our recommended fund list, prime funds, and part of our ready-made portfolios. So you can absolutely continue to stay invested in the fund. If you want to access the detailed analysis, please go to our website and you can access it. We leave the link in the description box below. So go ahead and check it out. And don't forget to subscribe to Prime Investor for more such analysis and insights about funds, stocks, bonds, deposits, ETFs, and more. Thank you.